Good morning, everyone. Thank you for coming today. I really do appreciate it. We're gonna talk today about different option strategies and how they're the same and how they're different. Kind of compare and contrast them just a little bit to help everyone get a better understanding of what that option trade really is. You know, when I first started in options, I'm a very visual trader. Anyone here, I think most people are, particularly men, are very visual traders or visual learners. Anyone else here kind of a visual learner? You kind of have to put your hands on it, um, sketch it out, whatever it is to really understand it. You get that imprint in your mind's eye, and then you understand it, right? And when I first started trying to decipher a P&L graph for an option strategy was just like it was like, I don't know, I felt like I was looking at a totally different language. It just didn't make any sense to me. And once I finally started getting it figured out, I noticed that a lot of these trades are um, very similar in nature in a lot of different ways. And we'll talk just a little bit about why or when you'd want to switch up a strategy for a trade, but how they're all really interconnected. Okay, so we're going to start off. I'm going to get Thinkorswim up here, and we're going to run over here to the Analyze tab. Let's see, make sure you guys can see everything that you're supposed to be able to see. I had to adjust this around a little bit yesterday for a coaching session. So let's take a look. Let's just grab any stock. Let's bring up Intel. And let's kind of take a look at how so many of these things are very, very similar. So everyone understands the idea of buying a straight up stock. We want to buy low and sell high, or we want to sell high and buy low, right? Buy a back low. So if we were to just pick up a stock trade here, adjust this so you guys can see a little bit. There we go. So we just pick up 100 shares in a stock trade, and we take a look at the P&L graph. Oops, that's not going to do it because I have that trade on. There we go. It's going to look just like this. Okay, that's your standard stock trade, and you can shrink this up as much as you want. And it's just essentially a 45-degree angle from 0 to infinity. That's all it is. Anything along this line here is the price of the stock, and anything along here is the potential profit. Okay, so everyone can kind of understand that. Well, let's just take this section right here. And if we were to place a stop loss, put a stop loss on this, what would that look like? Well, I'm just going to draw an arrow on here on the chart. If we were to place a stop loss here at 90, okay, this part of the line right here would go away, and we would have a straight across line right here. Okay, so that straight across line is just nothing more than the prices, okay, being capped. We've cut the risk off of this trade. Okay, goes like that. What if we put a price target on there and set an order in the market for a price target? The chart turns into this because we cap the top side. Okay, we put a floor under it. We put a lid on it. Now, if you notice right here, if we were to draw a line in between, what did we just draw? We drew the P&L graph of a debit spread. We drew the P&L graph of a calendar spread. We drew the P&L graph of a vertical spread. Okay, so it's very, very similar all the way through. All of these things relate to each other. If we want a covered call trade looks like this. So we have our potential that this could go to zero, but we've capped our potential return on the trade by selling a call option. Okay, so these are all very, very the same. So let's take this one step further. Let's look at a short trade. If we short the stock, all we did is switch direction. Okay, if we short the stock, we have a tremendous potential risk here. Why is that out there to 119? That's weird. Huh. See if that changes. There we go. If we change this to a short trade, notice in here, as we move our cursor up and down here, if the stock goes down, we have the ability to make money, obviously, to zero. The stock can go all the way to zero. The more it goes up from here in price, the more money we lose. Okay? Well, we can do the same thing here on this trade. If we wanted to set a stop loss, it changes the chart to look like this. And if we put a profit target on this trade, it changes the chart to look like this. Connect the dots here, and what did we just create? Another very similar chart to any spread. It's essentially identical. Okay? Anybody? William, yes. Call spread. Okay, so the last one we looked at was a put spread. So let's keep going here. How could we create that same scenario with options rather than using a stock? Get the same picture in a trade. What would that look like? Whoops, let's go back here. If we were to open up, let's just use these Junes, and we buy a call option, okay, let's look at the risk profile. We buy a call option, and notice we have unlimited upside potential here, but why the straight line here? The reason is because the call option can only lose, how much you've put into the trade. Yeah, it can only lose. So we mimic the stock position here but it automatically cuts off our loss right here. So we still have that potential, that 45-degree rally here that could go to infinity, but we have a maximum loss in the trade that is limited and an unlimited potential reward. We take this trade and we sell a call option against it, and what did we create? That same pattern again. It could be a fig leaf. Yeah, if we use, it could be a calendar spread. It could be a debit spread. It could be a fig leaf. It's all very, very similar, right? In how they lay out. So one of the tricks, I think, to understanding how all of these strategies compare with each other and contrast with each other is to begin to understand that visual effect, that visual of what that chart would look like, what we're actually setting up. Okay? And it gives you a really I think it helps a lot in giving everyone that clearer picture of what this trade would actually look like if we put it together on a chart. Okay. Now, a couple of things I'm using here. And we're probably just going to stick with this. There's no need to change. I'm not looking at the various aspects of the delta and things right now. We will here in a second. But what I'm trying to do is show you that how these relate directly to a stock trade. Okay? A lot of people understand that they get the idea that calls are for the long side of a trade. And they get the idea that puts are for a short side of the trade. Okay. But they don't quite get the relationship between the long and short side of the trade as in respect of the stock itself. Essentially, what calls and puts have done is they've snapped the stock trade in half and made two pieces out of it. So you have a stock trade. It has both sides, the positive and the negative, in that stock trade. It can go up, it can go down. By buying just straight up calls and puts, we're actually taking risk to just one side of the trade. Now, there's a downside on every long trade. There's a downside to every short trade, okay, based on how much we spent. But essentially, we've broken this trade in half. We've broken the stock trade in half. And that's why we've got basically 50 deltas here and 50 deltas here on the same strike. You can see they're actually, they should add up to 100. This is showing ticked just one off. But we've got an even trade here. Okay, this is the bullish side. This is the bearish side. So if we take that same strike, we bought the call option, and let's just buy a put option and look at the risk profile. Okay, all we've done in this trade is we've capped this position at the maximum that we paid, that we collected on the trade. We collected 284. That's the most we can make. But understand, this has the same profile of that stock trade, because if it goes down, Okay, that's where we achieve our maximum loss if it goes to 0. Okay, so when you start combining all of these elements, then we start to get a clearer picture of those P&L graphs. Let's take this another step further and let's put on a trade. Thinkorswim calls it a combo. Okay, but this is a synthetic stock position because we picked up both sides of this trade. We picked up the positive, the long call. We picked up the negative by picking up the short put. And essentially we've mimicked the stock trade. Okay, the stock trade would cost us $49.45 to do. Okay. Doing this costs us 14 cents per share. Okay, let's look at the trade. It's identical to the stock trade. Okay, because we've picked up both elements. We've picked up the upside and we've picked up the downside so that this mimics, this can go all the way to 0, this can go to infinity. It mimics the stock trade exactly. Is this making sense, guys? And stop me if this is confusing. All right, cool. Now we can use this similar situation here. And can we put a stop loss on this? Yep, put a stop loss on this. Turns it into that. Put a profit target on this. Turns it into that. Very, very similar in the entire setup, right? Look at how it all ends up being basically the same thing. One pattern to rule them all. There you go. That's got to be a Lord of the Rings reference, right? One ring to rule them all. Now we can do the same thing with a short trade. Whoops. We're going to do this in just the opposite way. When we were trying to mimic the stock trade long, we bought the long call and bought the short put. We want to mimic a short trade. We're going to buy the long put, sell the long call. Okay, this trade actually achieves a credit. Let's take a look at the risk profile. The risk profile is identical to a short trade. I'm showing these just to show, I'm trying to stay consistent with the strikes. I'm not trying to tell you the rules or anything like here. What I'm trying to do is compare and contrast how they're the same, so that everyone can begin to understand they're very, very similar in the aspects of just a straight up stock trade. We're just doing different combinations to show you different ways to create the same trade. Okay. Typically, when you do synthetic positions, and this is a synthetic short, when you do synthetic positions, they're going to be at the money. Okay. They're going to be at the money, typically. Okay. Now, on this position, if we place a stop loss, what do? We place a stop loss on this trade. Notice that we're losing money on this side, right? Because we're shorting this trade. We gain money as it goes towards zero. So what we're going to do to place a stop loss on here is cap the downside. If we place a profit target on our short, we cap the upside, and we just turn this into an identical looking trade to a spread trade. It's identical to a credit spread, right? A call credit spread. So we've given ourselves so many different ways that we can trade the same position. Okay, how we can easily compare these different setups to each other and give ourselves an opportunity to understand all of them together. Okay, let's take a look. What if we buy the stock? Let's buy the stock, and then let's sell an out of the money call. What's that going to look like? Well, this is a covered call trade, right? A simple covered call trade. So what we've done here in the covered call trade is our stock position can move on up, but only to here. We've capped our potential return on the trade. It can no longer go to infinity because we've given someone the right to buy the stock from us at a higher price. Okay? Very similar. Now, in a covered call trade, there's no protection to the downside, right? The actual covered call. No protection to the downside. So, if we were to take this and put a stop loss on this trade, what did we just create? The same pattern. Okay? Or essentially a bull put credit spread. Okay, they're all very, very similar in how they set up and lay out. So let's go into a debit spread. Talk about that debit spread a little bit. Let's go back here and let's place a debit spread, and let's try to use our rules. We're going to buy something around 70 deltas, our contract. And we're going to sell something around 30 deltas. I don't have a 30 delta, but we'll do this one. 30 deltas or less. And we create a debit spread. Okay, this is going to cost us to put in the money in the trade. But notice, Thinkorswim calls it a vertical. Okay. Now, why would they call a debit spread a vertical? Well, the reason is when we look at the graph, okay, this would be the stock portion of the trade right here. This is the stock portion of the trade. This is our profit cap. This is our stop loss. Okay, this is our maximum risk on the trade down here. This is our maximum profit in the trade up here on that debit spread, and all we've done is create this range where we're obviously in a debit spread. We want this to be bullish. And let me write this stuff down on here for you guys that might be confused about this. What we want to do, and we'll go back through those others as well. What we want to do to construct a proper debit spread is we want to get a with calls anyway. We want to buy an option that's somewhere between 70 and 80 deltas, right? For the long side of the trade. That's for the long side of the trade. And the reason we want to do that is that fits our rules and our goals. We know that an option here that's somewhere between 70 and 80 deltas has a high probability of staying in the money. Okay? So we pick the right option on that side. To sell the option, we're going to look for an option that has somewhere around 30 deltas or less in the trade. Okay, 30 deltas or less, we know that that option has a 70% chance of expiring out of the money or giving us the best opportunity to really win on both of these sides. A high probability trade. Debit spread means, yes, Bal, debit spread means that you are laying out money. It costs you to put this trade on. Okay? Costs you to put their trades on. Gordon, let's talk about that just a little bit here. To understand how trades are going to affect you on costs and potential risks, you have to learn to define your risk or your rights and obligations in a trade. Okay? So the option we bought here gives us a right to buy Intel at $45. So if we have $45 for a right, we can buy it at $45. Okay? The one we sold gives someone else the right to buy the stock from us at $55. Okay? So if you know that you have a right to buy the stock at $45 and given someone the right to buy it from you at $55, what's your maximum profit in this trade? Yeah, we got 10 points, but we had a cost to get into the trade, right? So we have $10 minus $4.59. That's what it cost us to get into the trade. That's our max. That'll be our maximum profit. So you just subtract your costs from that, and now you have your trade. So in that situation, what's your maximum risk on this trade? If you have a right to buy it at 45, you've given someone the right to buy it from you at 55, you collected a premium on this. What's the maximum risk on a long call? What you paid to get into it. By selling that call option against it, we've lowered our risk on the trade to $4.59. That's the maximum we can lose on a trade. Okay? We can't lose any more. That's a standard debit spread. Let's compare that though. Oops, I keep going back to the trade page. I don't mean to do that. Let's compare that. Let's say we buy this option. We buy our correct option here. But instead of selling the straight on debit spread, which a debit spread is in the same month. Okay? So if we buy one and sell one in the same month, that's a debit spread. If we were to move up here and sell the May call, okay, shouldn't have done that way. Need to hold this down and make them one trade. Thinkorswim calls it a diagonal. Okay, it's a diagonal because it's in two separate months. Okay, but let's look at the risk profile. The risk profile is essentially identical, right? There's our capped win. Here's the stock trade that we're mimicking. Here's our max risk. Okay, this is a calendar spread. Okay, in this trade, when you think about rights and obligations, we have a right to buy the stock at 45 in May. Okay, there's our right in May. And we've given someone the right to buy the stock from us at 52.5. Or excuse me, right to buy it in June. The right to we sold someone the right to sell buy it from us in May at 52.5. Okay, because we believe it probably won't go up that high. And if it does and they take it away, it's okay. But notice it's the same profile in the trade. It's virtually identical to owning the stock, putting a profit target, and setting a stop loss. Virtually identical. Okay, when you decipher this trade, if we have the long call at 45 and the short call at 52.5, what's our maximum risk in this trade? What we paid for the trade, right? You're going to figure out word problem. John, yeah. If you get called away, you get forced to take a 74% gain. Okay. Now, people get really confused or concerned about that short strike, because if you have a short strike in a trade and the stock goes above your short strike, and you look at your Thinkorswim or any other platform, let's say we sold that. I don't know what we sold that for. Let's say we sold it for $1.50. If you sell it for $1.50 and the stock moves up above your short strike, this option may be worth $3 up there. So it's going to show in your account that you've lost $150. Okay? But have you lost $150? Think about that. No, you really haven't. They have to show you that on paper because on paper you have lost $150. But remember, when you first sold this, you collected this to your account. That's in your account already. This could go to $10, and it doesn't matter as long as you don't buy it back. If you buy it back, you're locking in a loss. On a situation like that, what's going to happen is you will either get called away on the trade, an early exercise prior to expiration, or at expiration, you will get called away. And again, all you have to do when you get called away, you have the right here to buy the stock at 45. If someone calls your position at 52.5, you just exercise your right at 45 to buy it. The transfer happens automatically. You never see that stock in your account. It just immediately transfers to the new owner at 52.5. You buy the stock at 45. You sell the stock at 52.5. You subtract your cost of the trade to enter the position, and that will come up with your profit. William, yes, max loss. Well, look at it right here. Okay, we have our 45, but we collected, remember, we collected money on this trade. So that lowered our risk in this position, right? That means the stock can actually go below 45, okay, before we really lose money, too much money on the trade. So right here, it's at 50. Now watch the purple line, the purple number over there in the left corner. If it moves down to 45, we're going to lose $180. Okay, not the full 430. We're going to lose $180 if it moves down there today or quickly. Okay. If we held it all the way through expiration, which is the blue line, we're going to lose $263. Just a little more than half of what we originally put into the trade. The reason is because we collected a premium on the position. Because that short strike, if you separate out the two trades, you lost money on your long call position, but you made maximum profit on your short call position, which is how much you collected when you put the trade on. Okay? So you've essentially taken a long call position and hedged it. Does that make sense, William? Rick, I'm trying to be a little bit more detailed in the individual positions, but we haven't derailed. We really haven't derailed. What is this trade? This trade is long stock, profit target, stop loss. That's what it is. Because we're using a calendar spread, this option here has less time to expiration than our 45 strike. that means that this could expire worthless, and in the next month sell another and collect even more on the trade, reducing our cost in the position, reducing our max risk. Think about this for a second when you're thinking about these kind of trades. If we put on a trade, let's say we put on a trade and the original long position costs us $10. Okay? And we sell a short-term option against that. Let's say this is a leap option, goes all the way out for a year. And we sell the front month call against it, out of the money call, and it expires worthless. We collected $1 on it. Okay? So if we've collected $1, what's our max risk in this trade now? $9. If we do it the next month, collect $1, our max risk in the trade is now $8. Okay? Yeah, we're reducing that cost basis because we're collecting premium to the trade. We're reducing our cost of the trade. Okay? But here's the thing with these trades, you have to think of them in context of the entire position. If this is working and you've collected premiums 4 or 5 times and then the stock falls, it's still going to look like a giant loss on that trade, right? But you have to put it together. Well, but I've collected, along the way, I've collected $500 or 5 premiums on that trade. If this falls, okay, below your $10 here, you've still made money on the trade as long as you use a stop loss and exit that trade. Okay. Now, let's keep in mind that what we just did there with the calendar spread is the same thing that we're doing with a fig leaf trade. The difference in the fig leaf trade is we're going to pick up a longer term option because I've already got this one on here. I'm going to go further out. Let's go to the January. Let's go here. And we buy this option here. And then we sell a short-term option against it. It's the same trade. It has these sways in it. It has these sways in it because of the length of time and the expiration, but essentially it's the same trade. Here's the long stock. Here's our profit cap. Here's our max risk, our stop loss. It's the same position. Okay? Exact same trade. Now, because we have a long-term option here, it gives us an opportunity to take advantage of a longer-term trend and continuously working to lower the cost basis in our trade by selling call options against it. The other way you could look at it is, if anyone was thinking about dividend trading or collecting a dividend, we all know that our dividend is just, most stocks is once a quarter, right? Every quarter there's a dividend payment. Well, we could achieve the same thing, get a dividend payment, but do it every month. Essentially lowering the cost of our trade. Okay, so what I've shown you here is that the basic trades are all the same. We have the element of the stock, whether it be long or short. By selling a call against the trade, we've put a profit target on it. By buying or putting a stop loss on, we've put a max loss on the trade, or a stop loss. So this is right here a fig leaf, a debit spread, a credit spread. It has the element of a covered call with a stop loss. It has the element of a synthetic position with a profit target and a stop loss. Yeah, it could easily be a lot higher. You're right, Terry. Fig leaf is a great strategy if you like longer term trades, Gordon, and if you're in a trending market. Okay, so you in a trending market, you can buy that long option. Now, just remember, you still have to manage the downside. You still have to manage the downside. Okay. Now, what if we were to take a trade and add elements of both a long trade and a short trade together? If we do a bull call spread, a debit spread, a credit spread, a bear call credit spread. We'll talk about that. It looks like that, right? Well, actually, it's not. It's reversed. Yes, synthetic is directional, absolutely directional. Let's put on a call credit spread. Same trade. We're going to take our short-term option here, and we're going to put on a call credit spread. We're going to sell the one that's about 30 deltas. We're going to buy the one further out from that. Doesn't matter if it's a $2 or $1 or $2.50, whatever it is, and we collect a credit to put on the trade. When we collect a credit to put on the trade in a credit spread, it's going to show us this profile. Okay, this profile is the short side of the trade. Imagine this being short the stock. Imagine this being our max profit, our target, and this is our stop loss. Okay, because if we look at across here, our max profit is here, $57. Our max loss is here, $193. Now, how do we get there? Well, we're $2.50 wide. Notice we're buying the 52.5. We're selling the 55. So we're $2.50 wide. 250 minus what we collected, 57 cents. Whoops. And our max loss is 193. Okay. Now we can add a bull put credit spread to this. What do? So all we're doing here is we're adding two elements. Okay, we're adding the element of being long a trade with the element of being short the trade. We're bringing them together. We have maximums on both sides for losses and maximum profits on both sides of the trade. We created an iron condor. yes, a synthetic is always going to be directional. Okay. So that's all we've done is we've added those elements together. This is long the stock. This is short the stock. This is maximum profit on both of them. This is our stop loss on both of them. We've just added the two trades together. And essentially what we're trying to do is we're trying to trap the stock in this range. Is this making sense? So all of these trades are similar, right? And if you can understand the rights and obligations and putting together these pieces, you can decipher any position. You can figure out max profit and max loss very easily in every position in the trade. Okay? It's not that hard to do. Now, with any of these trades, we can set up orders to protect ourselves for the downside. Okay? However we want to do that, we can set an order to protect ourselves. Now, one of the reasons I use conditional orders so much is because I'm looking at the excuse me. Pardon me for coughing in your ear. I use the chart. I'm using the price action. So naturally, I'm going to go to the price action of the chart to determine where I'm wrong on the trade. Okay. So if I'm going to buy a stock position, I'm going to look at that chart and I'm going to determine how much risk I'm willing to take and where I've decided I'm going to be wrong on the trade. And I'm going to place a stop loss to protect myself. That cuts off that trade. Maximum loss. Okay? Maximum loss. So if I compare that to any other trade, let's take a look at a synthetic long position. It's identical to the stock trade. How can I protect myself in this position? Well, I can do a couple things. If the stock were to fall below a specific price level, I can have a conditional order to sell this trade if it falls to a specific point on the chart. I want out. Okay, I want out. So I can just set conditions. If it falls below 40, if the stock falls below 40, sell this position. Boom, conditional order, I'm out of the trade. I could also do something like this. If I say 40 is the number that I want to protect, notice this is a 12-cent cost to get into this trade. Cost us 12 cents a share to get in this trade. I can change this by placing my stop loss on this trade and capping my losses in the trade wherever I want them to be. Because all I'd have to do is buy a put option onto this trade. And now, doesn't this look exactly the same as a long call? That's a long call right there. The same trade. The same profile in the graph. It's a long call. Okay. But in this trade, notice that we're only spending $1.25. Our max loss on this trade is different though than if we buy a long call, our max loss on the trade would be what we paid on the trade. Our max loss on this is where we cut off the risk or place that stop loss. So this trade has a maximum loss as it stands at about 425. It has an unlimited upside profit potential. Okay, let me show you this just to compare. We're just going to grab a long call. The same position, right? It's the same trade. We've just used a different combination of options to make that trade happen. So we put on the synthetic. We set our stop loss wherever we want to set our stop loss by buying that put. Okay. No, that was stupid. Here we go. Look at the risk profile. It's the same as the long call. This has a max risk now, the way I set this one, at 396 or 386. And an unlimited upside potential. It's because of where we set the stop loss. Our risk, when we bought this put, we have our long call here at 49 on this one, right? Our long call's at 49. We have the right to buy the stock at 49. We bought the 47 put here. The 47 put says we have the right to sell the stock at 47. So what's our max risk on this trade? Our max risk on this trade is the difference between the spread, okay? $2, okay? Plus our cost to get into the trade. Would I sell the put if the market dips? You mean trying to take a profit on the put? And if I'm afraid you're going to confuse this a lot with a lot of folks here, T, but yes, you can. What I wouldn't consider it so much as a sell as I would as a roll. Okay. If the stock pulls back and you've made money on that long put, you could sell that put for a profit, buy another put for your stop loss. Okay. Buy a put for the stop loss, and then just roll it to a different strike. Because the one thing you don't want to do is just sell that put and then have a position with unlimited, well, a risk to zero. You could sell the put and put on a conditional order to exit the trade at a specific price. That does the same thing. Okay. That does the same thing. Jim, this is cheaper than buying a call, but it carries a different risk profile. Okay. We know when we sell a call option, or excuse me, buy a call option, let's buy this 72 strike call here. If we buy that call option, our maximum risk in the trade is $475. That's what we've paid for the position. Okay. If we put on the synthetic long trade and then set a stop loss $2 away, what's our max risk on this trade? It's a little bit cheaper in this circumstance. It might not be. And the $2 stop loss may not be the right place to put the stop, right? I'm just throwing, I'm not looking at a chart. It may not be the right place to put on the stop. Okay. And you're assuming that you're not placing a stop on your long call. Okay. If you're placing a stop on your long call, you're cutting that risk. Right? You're stopping out. So it all depends on how you set that up, whether it's going to be less or more or whatever. Just remember, in this trade, you have to figure out your maximum loss is going to be your long strike, your 49 here, and your 47, which is your stop, $2 plus the cost of getting into the trade is what your actual risk is. Yes, this is being recorded. Okay. So you can see there's so many different ways to construct a position that's essentially the same profile. They give them different names because they have a little bit different aspects in the trade. Okay. Now, when do you want to take, what would be a reason for taking a fig leaf? What would be a reason for taking a fig leaf? Long-term directional assumption is what you want to have here. Yeah, it's cheaper. It's cheaper by far, John. A lot cheaper. But to take that, you want a long-term directional assumption in the trade, right? Yeah. We're bullish on the stock on the long term. Okay. Now let's break that down. Let's go a little bit further. What if we do a calendar spread? What do we want to have for an assumption on this trade? Calendar spread could be a long-term trend, right? Or it could be a short-term. But you're also bullish on the trade, directionally long. And the reason for doing that, the reason for using the calendar spread, is to lower the cost of the trade, because we have that element of the short strike. We're doing the same thing in the fig leaf. The fig leaf, we paid X amount, we subtract how much we collected on the premium on the short strike, and that's our max risk in the trade. The calendar spread is the same thing. We have our long strike minus our short strike, and that's our max risk in the trade. we're lowering it out. Now you'd want to use the calendar if you thought you had an opportunity to sell calls against it more than once, right? This is two separate months, two different months to set up the calendar. Just like this is in the fig leaf. So you may have a long-term assumption on this one, but this one you're only thinking probably a 2 or 3 month trend. For the calendar. What if we use a debit spread? Debit spreads can both be long-term and short-term, right? We can sell the front month and a front month debit spread on here that's only for that 30-day period of time. We still have a directional assumption on this if we buy the call debit spread that the stock is moving up. Okay, all we've done is set a stop loss and a profit target in a debit spread. Yeah, and any of these trades can be flipped over to the put side of the, if you're, short on a trade and want to be trading directionally short. Any of these can be flipped over. If you have a long-term assumption short on a trade, you just do the opposite that you do here with the calls. Is a calendar spread good for an earnings play? I would say, well, think about that for a second on the calendar spread. We don't know what's going to happen in the event of an earnings. Okay. So as long as you're comfortable with the maximum loss of that trade, sure, you can use it for an earnings trade. John, I'm going to disagree with you on that. You buy an out of the money call and buy an out of the money put. Okay. What is that trade? You buy an out of the money call, buy an out of the money put. It's a strangle. Okay. The problem with this trade is it's a very expensive trade. Okay? It's not as expensive as the straddle. Okay? But the odds on this trade are not good. Okay? It's a gamble. And anytime you trade earnings, guys, just keep this in mind. If you're trading earnings, you're gambling. And it's okay to do that. But don't do it as a habit. Because the only way this can work is the stock has to move enough to cover the total loss of the other option. And move enough to cover the implied volatility collapse. That's why straddles and strangles have a very low win-loss ratio. They're one of the most expensive option trades that you can have, and they have a low win-loss ratio. William, are you talking about selling a strangle to do the reverse? Well, let's just look at it. And this is where you guys really need to get in here and practice this stuff. You learn so much about a trade. Let's sell a strangle. Sell the call, sell the put. Let's take a look at the profile here. What did we do in this? Our profit is this credit right here. That's our max profit. It has an unlimited upside loss and an to zero, huge, almost an unlimited downside loss. So are you going to bet that you know that the stock at earnings is going to land in here and take these kind of massive risks on both sides of the trade? Okay. Actually, Greg, I would say not even iron condors. Some of the best positions that you can trade for earnings is like a broken wing butterfly, where you can take a credit on the trade and eliminate one side of the risk. A back ratio spread can be used for those. Because we generally get a big move at earnings, generally. But it may not be big enough to make up for a straddle or a strangle, where a back ratio spread might work. Okay? So I don't want to confuse this too much. What I was trying to do is stick on the subject that how these trades are very, very similar. So we take, and how we need to think about those trades. We take a long stock position, we turn it into a call option, and we've just shut off the downside risk on that trade. Unlimited upside potential, downside risk. We take a fig leaf trade, a long-term option directional, and we sell a call against it. We've capped the top side on that trade. If we put a stop loss on the fig leaf trade, we've essentially created the same profile as a debit spread, a credit spread, a covered call with a stop, a synthetic trade with a profit target and a stop. They're all the same profile. But Greg, I mean, you know as well as anybody, the last four earnings events do not equal this earnings event. It's a complete unknown. You're guessing just like anybody else. You're just trying to apply some rationale to it and say that makes up for the gambling. But it's still a gamble. It's just like the guy that bets on horse races because he has a system. It doesn't change the fact that this event is different than every other. Stocks change character all the time, right? Companies lose money. Lawsuits happen. Events occur. And you can't predict that by looking at the last four earnings events. Because that has nothing to do with the one that's coming. Tariffs might be placed. That's right. That's right. And here's the thing. You can do all of that gambling, and that's fine. I don't mind it. I mean, if you've got the gambling money to do it, go ahead and do it. Everybody wants to gamble once in a while. Just don't make a permanent habit out of it. And the other thing is keep in mind that it only takes on iron condors or anything like that. It only takes one really bad trade to wipe out a whole bunch of good ones. So people who make a constant diet out of trying to do that rarely see their account grow much, if at all, because the losers are so big and the winners are so small. You guys are funny. So there's just no way that you can look at past history and say that that is going to be representative of the future. We don't know that. Okay? Be careful of that kind of thinking. See, one of the things that I despise about the option industry is it breeds this idea of gambling, the get rich quick scheme. And that's why 90% of all option traders lose money. Because they get involved in that gambling. They don't take high probability trades. They try to make the big win. And they get just enough big wins to make them think they can do it. And then their account just continues to get smaller and smaller and smaller. Okay, so what we need to do is we need to switch that up. We need to switch that up. William, 90% of stock traders do not lose money because maybe 90% of retail stock traders lose money. But the retail traders are a small portion, or day traders or things like that, lose money if they're swing trading or something like that. But even a retail trader that just builds a portfolio for a long term may not lose money. Yeah, day traders, I would say that percentage is even higher. And those who do finally make money lost money for a long time before they started making any money, because it's a challenging way of trading. Okay. So let's stay focused here and just realize all of these, that this isn't as complicated as you once thought. on laying out these different trades, how they're all very similar. So when you guys start thinking about um, any option trade, think of it in terms of the directional. Okay, am I directionally bullish or bearish on the trade? So if I'm bullish, I'm thinking long. So there's always the long stock element in that trade. Okay, now how you conform that with a call option, with a credit spread, a debit spread, or whatever, it all has the long stock element in the trade. And how we define our stops and how we define our profit targets is what makes that trade work or not work in the position. Okay, do we have odds in this trade? So it all, when we get into this, people kind of forget about the importance of price. Okay, and it doesn't matter what layout or setup you use, what's still the most important thing on every trade? Price. What is price doing? Because without the price moving in the right direction, without the correct pattern, the good setup, the low risk entry, it doesn't matter what setup you use or how complex or complicated you get into that trade. If price isn't moving, none of these trades are going to work. Okay? So first determine your directional assumption. Make sure you have a good quality trade that you're looking at. An option, just because it's an option, will not save your trading. If you cannot read price action, options won't fix your problem. It will not fix your problem. It'll make it worse. As a matter of fact, it'll shine a light on your biggest weaknesses like never before. If you trade with emotion, if you gamble, if you chase, all of those things, it will make the situation worse. And shine a light on it, a glaring light that the problem is not the market or anything else. The problem is you. So make sure whenever you think about these trades, get your directional assumption based on what you think that stock is doing, looking at the price action. Read that price action because it all starts there. Then you can construct just about any trade based on your assumption. Okay? Am I long or am I short? What's my risk tolerance in this trade? How can I offset that risk? Can I put a profit target in? All of those things are all combined right here in the same trade. You're either long the stock position or you're short the stock position. And there's really nothing in between. Okay? We all have targets, risk tolerances, and they all come together right here. The key element to make these work is right there. What's price doing? So you choose your strategy based on the timing, the direction, all those kind of things for the trade. Daniel, I don't understand your question. How does one get into to do this stuff discussed today? Um, Well, I'm showing you the Thinkorswim platform. If you have Thinkorswim, you can do exactly what I just showed you here and work on those strategies. Work on placing various trades and seeing how they form, what they look like. Rick, with the debit spread, I probably confused you in if we have a debit spread, it has a built-in profit cap and a built-in stop loss. This is our maximum profit. This is our maximum loss. Okay. I wouldn't combine a protective put in a trade like that because it raises the cost of the trade. You buy a put option, it raises your cost, right? You have a cost for buying the long call. You have a credit for selling the short call. Okay, so you collect up here. This costs you. If you add a put, you've added a third cost to this trade, or another cost to the trade, lowering your potential profit up here. So the better thing to do is just set a conditional order to exit the trade. There's no cost in a conditional order. Okay, we just set a stop loss at the price in the stock that we say, I'm wrong on the direction of this trade. Daniel, if you're a member here and you're trying to learn these strategies, ask the questions first. I answered the questions, ask the questions, and get in and study in the e-learning archive these different trades, because we separate these trades out in different classes, okay? And you just pick up, here's what I recommend to everyone. Don't try to learn them all at once. Take one strategy. Take one strategy and learn it. And Rick has told the story. He's almost tripled his option trading account this year. He's told everyone I'm the one helping him learn to trade options. And all he's doing right now is directional calls and puts. Thank you, Donna. So you don't have to get overly complicated first. In fact, I recommend you keep it simple. Okay? Keep it simple. And then start adding one strategy at a time. One strategy at a time. Okay? Because we all know if we just do a long call, we all know the long call has an unlimited potential upside and a maximum loss. That's a long call. If we choose, and we should choose, we want to manage that with a stop loss so that we don't take the maximum loss. And we manage that with a simple conditional order. Okay? But once you understand the long call, it's not much effort then to figure out the debit spread, the credit spread, the fig leaf, the synthetic, because they're all essentially the same trade. Just different time frames, different risk profiles. We just have to work through those details one thing at a time. So first thing you do is work on the basics. Understanding the call. Okay? That's what we want to do. Understand the call option. Understand the put option. Once you understand those two trade setups, then we start constructing other trades around them. There might be, Kevin. I don't know. What I would suggest, Kevin, is that you look at the price action of the chart. The chart's going to tell you if a stock is overbought or oversold. Right? If you get an extreme move in one direction or the other, you're overbought or oversold. The options are going to go right along with that. So when you say overvalued or undervalued, it's really the same terminology. If you're trying to get into finding the minutia where an option might be mispriced, don't waste your time with that. Don't waste your time with that. And the reason why is, Kevin, we can't. The big institutional computers are looking for that stuff all the time. The reason that doesn't occur very much, where there's something truly overvalued or undervalued, is because the big trading computers are sitting there trading that. If they identify it 2 or 3 cents out of balance, they trade it to bring it back into balance. Okay? And that's what the big institutions do. They have those high-powered computers sitting right on the backbone. Yeah, it's called arbitrage. And they arbitrage those numbers. They're trading for a penny or two to bring things back into balance. You cannot trade fast enough to do that, because the imbalances are so minute. Okay, if you're thinking of it along the stochastics, okay, Kevin, then look at the price of the stock. Take a look at a stock. Well, just take a look at the diamonds. Would you say currently the diamonds are oversold temporarily? 2 extreme move days. That means those put options are probably overbought. Okay? When a bounce occurs, we can take advantage of that, right? I gave a couple examples not that long ago. CEIN. CEI, for Pete's sake. Is it CIEN? Yeah, CIEN. CIEN had this extreme move, and I suggested a person could either short that or take this credit spread up here because of the condition of being temporarily overbought. Okay, we ran into resistance here. Those, whether you went short on the trade, bought a put option, or put on this credit spread, both of them would be profitable. So you look for those extreme moves. I suggest you wait for the sell pattern. And you can place those trades. That's your overbought and oversold. Now you're going to find that, or overextended in one way or another, you're going to find that by simply looking at price. Once again, I want to remind everyone, all trades begin right here with price. If you can learn to read price, all your trades begin here. And then you can construct any strategy you want around that trade to try and capture that position. Because if we went short a put here, that's a winning trade. If we put on the bear call credit spread up here, that's a winning trade. If we put on a synthetic put or a synthetic short position, that's a winning trade. If we put on a put debit spread, that would have been a winning trade. Lots and lots and lots of study, William. Lots of study. Looking at a lot of charts, and I've done it for years and years and years. I mark up, you see how I mark up charts. I used to spend hours doing nothing but marking up charts, taking a chart back in time, and studying the price action a day at a time. Seriously, hours doing this, studying the price action a day at a time, looking for the buy signals, looking for the best entry trades, over and over and over. Just keep working at it, and keep working at it, and keep working at it. People ask me, how did you learn to draw lines all over the chart? Find support and resistance and trend that quickly. I say, go out and draw 1,000 charts and then ask me that question. Because you draw up 1,000 charts, you're going to learn a lot. And if you still come back and say, I'm still struggling with this, I'm going to tell you, go draw 1,000 more charts. The more you work with the chart, the more you study the price action of the chart, you develop that skill. I don't have to have a single line on the chart. I've done this so long. I don't have to have a single line on the chart, and I can see every one of them. It's weird. It is really weird. But I can see every one of them. And it's only because I've put so much time and focus into drawing them up. Isn't that funny, John? Practice, practice, practice. Makes you better. Here's the thing. Here's the thing I would like to have you take away from that conversation we just had, William. Is that most people training for anything, they only want to train on the fun, sexy things. Okay. Go talk, excuse me, go talk to any football coach, any basketball coach, anybody. What do they train on? My favorite college coach of all time, Tom Osborne, was a maniac when it came to training on fundamentals. I mean, absolute maniac. They would be at a practice and they would run the same play until he felt like they got it right. And then they'd probably run it 20 more times to prove that they got it right. They would train and train and train and drill on the fundamentals. The sexy stuff happens as a result of training on the fundamentals. So in trading, take that same attitude towards your trading. There's no one here that wants to draw up 1,000 charts. I get it. It's not, for some people, that's just the most mind-numbing, boring thing there is. And when you first start, it takes a long time, right? To just draw up a dozen charts, it takes a long time. Because you have to work at it a little bit. You have to study that price action. It's relaxing for me too. Very relaxing for me. That's my downtime. I love setting and looking at charts and doing that. So when I start working through a chart, take it a piece at a time and just work through that list. Get your CBOE list. Sort that list by the stocks that are trending, they're doing something that you like, and get into those charts and draw them up. And every day, look at those same charts. Every day, adjust those drawings as necessary. Every day, continue to focus on that price action. And every day, it gets easier. You start seeing more things in a chart. You start seeing the patterns clearer. You start seeing the support, resistance, and trend. Train on the fundamentals most of the time. And the sexy stuff happens as a result. Sexy is the profits, right? That will happen if you train on the fundamentals. Train and train and train and train. I've been doing this for 29 years now. And every day, I still look at charts and draw them up. Every day, I'm adjusting drawings. Every day, I'm running through several hundred charts. Because I know my next trade, my best trade ever, may come in one of those charts. And if I haven't found it, if I haven't drawn it up, if I'm not prepared for it, how in the world do I ever expect to make money on it? The fundamentals first, the trade second. Greg, yeah, I totally agree with that. That's, Trader Vision 2020, that's what it's meant to do. When you make a trade, you actually have a full planned out trade, and it records all that information for you so that you can go back and see what's working for you and what's not. Okay. It automatically tracks your performance and says, this is where, and it's going to show you. Well, when I trade this pattern, I win most of the time. When I trade this pattern, I stink on ice. Okay. So the more you practice, the more you capture that data and plan. And it's all in your trade plan, right? If you have your trade plan set up correctly, you're going to learn a lot about yourself and whether or not that's the right trade for you. Plan your trades. Keep records. I say this a lot, and I know some of you guys are probably tired of hearing me say it. But trading is a business, just like any other. And businesses require planning, record keeping, training, all the time. All the time. Every business has to have records. Every business has to have a plan. Every business has to train its employees to be successful at what they do. That's you. You're the CEO and the employee. You have to be your own tough boss. You have to maintain records. You have to maintain plans. You have to train to be good at the job. Let's take example, years ago, I don't know if Bob C's here. I don't see Bob C in the list. Oh, Bob C is here. Years and years ago, they used to, almost all jobs in some way, shape, or form had an apprenticeship. Okay? Where you went and you worked under someone that was already a master and learned from them that skill. And those apprenticeships used to be really long. Okay? Bob C is a plumber. I was a carpenter. Okay? I didn't pop out onto the job site knowing how to build a house. Start to finish. Didn't know how to do it. So guess what I learned during that process? It was training. It was always training. I learned to do one aspect, and I learned until I got good at that. And then I moved to the next piece, and the next piece, and the next piece, and the next piece. And you train over and over and over on that, and you do it long enough, you can build a house, you could plumb a house, you could put together a boiler in your sleep. Okay? So it's that training, it's that working on the fundamentals that's always the most important. That's going to make you successful. But if you don't do that work, if you're unwilling to do that work, you're always going to be in a situation where you're struggling, failing, losing money. And isn't that the nature of most people? We're lazy. Who wants to do that kind of work? I mean, I'm lazy. I know it. And so I have to push myself every day to keep doing the important things. We all have to do that. I'm telling you, guys, if you're sitting in your trading room watching CNBC with no plan for your day, no schedule for your day, you're not a professional trader. You're not even a very good hobbyist at that point. Because you need to be spending your day focusing on the important parts of your business and the fundamental things that you have to accomplish if you're going to achieve success. We all have to do that. So get into that role. Be the tough boss. that pushes you to do better, to expect more, to improve every day. And don't beat yourself up for making a mistake. Learn from your mistake. Don't repeat it. I used to tell people on my construction crew, all I cared mostly about was honesty. That they worked hard and that they were honest. Okay? I had no problem. People on my crew would not get yelled at for making a mistake. What they would get yelled at for is hiding that mistake or not learning from that mistake. In fact, I used to say it, I said it so much with my crews, if you're not screwing up at least once a day, you're not doing enough. So get in there and practice. Drill on those fundamentals. It's funny to me that we'll show I'll tell people to practice their conditional orders and practice that kind of stuff. And they'll go do they'll do it a couple times in a paper trade system, and then they won't do it again for 2 months and then won't remember how to do it. Well, duh. In a paper trade account, make that thing smoke. Make it work so hard it's smoking. Place those trades. Put on fig leaves. Put on iron condors. Put on debit spreads. Put on credit spreads. And it doesn't matter if you win or lose on them. What matters is that you learn from it. Work it to death. You trade a whole bunch of fig leaves. You trade a whole bunch of iron condors. You trade a whole bunch of debit spreads. And pretty soon, you can do them in your sleep. Drill on the fundamentals. Drill, drill, drill. Keep doing it over and over and over. And all of a sudden, it becomes easy. It's not that hard. That's awesome, Bobby. That's awesome. That's awesome. Well, hey guys, we've gone about 2 hours here. I didn't mean to get on a soapbox there. Um, but that's really important stuff. And thanks for bringing it up. So hopefully you guys got something out of this today where you can see that all of these trades kind of relate, and it all bases right back to beginning with the price action of the chart and then establishing the trade setup that you prefer the most for that setup. Okay? And then you can learn to construct really any trade with a simple understanding of rights and obligations and building out that position. Okay? I believe in you guys. Seriously, I do. You come in here, you show up on a Saturday morning, sit here for 2 hours. I believe you guys can do this. I know you can. Now just work on those aspects, pull that stuff together, and all of a sudden it'll click and it'll go, man, I get that. I understand that now. I can see that. You know, I can see a bull call spread in my head. I can see a bear call spread in my head. I can see that debit spread. I know what that synthetic position looks like. I can see it. I know what it looks like if I apply a put to it or if I put a profit target on it. I know what that looks like. You do that, and you'll start seeing a lot of success in your trading. So just keep up the good hard work, and thanks for coming today. I really do appreciate it. You guys are awesome. As soon as I can, I am going to get this posted on the website. I don't know if I'll get it done this weekend or not, but it will be for sure there by Monday morning. I'll try to get it there this weekend. Okay. Thanks, guys. I appreciate it. Everyone have an awesome weekend. And we'll catch you all Monday morning. Be safe. See you right back here. Take care, guys.